Good afternoon, everyone. My name is Natalie Colley. I'm a senior lead advisor and a partner at Francis Financial, coming to you today with a special video about how we are thinking about and navigating the market these days. For reference, today is Monday, April 7th, 2025, um, and it's just about at the end of the trading day. So the last 3 days have been incredibly volatile in the S&P 500 index. We saw over last Thursday and Friday, it fell 10%. Today, at some points, it was anywhere between 1% and 2% and up. It's just a little bit negative right now, but not too terrible. And we haven't seen this type of a drawdown so quickly since really 5 years ago during the beginning of the COVID pandemic crisis. Prior to that, the global financial crisis, we saw some volatility like this a few times. And then prior to that was really Black Monday, October 1987. So investors are feeling rattled, to say the least. Some are starting to panic, and at the very least, investors are really asking themselves, what should we be doing? How should we be thinking about this today? Um, our first message is really to take a step back, zoom out a little bit. You may be surprised to hear that, although people are talking about the market, what they're really talking about is they're focusing on the S&P 500, right? US stocks in particular. But if you're a diversified portfolio or a diversified investor, you should have a mix of not just stocks, but also bonds, and not just US stocks, but US stocks and non-US stocks as well. So investors might be surprised to hear that bonds actually are up almost 4% year to date. And non-US stocks, developed international and emerging markets, are both up over 1% year to date as well. So, we're starting to see some of the benefits of diversification come into play here. And if you're in a balanced portfolio, 60-40 or so, your portfolio is likely down, anywhere between 3 and 7%, depending on what your actual target allocation is within that portfolio. So no one likes to see their portfolio negative. I don't like it either, and especially investors who are diligently saving and contributing and investing in the market and watching their account balances grow. You don't like to see it down for any period of time. But when you're comparing it to the S&P 500, which is down about 15% year to date, 20% from its all-time highs, nearly 5, 6, 7% even, is not so terrible. It's about half of that. So again, silver lining, diversification is starting to do what it is meant to do. So what's an investor to do right now? And during times like these, I always like to go back to the analogy of a ship. And it works really well because, of course, cargo ships bringing in all these goods that are going to be taxed at really high tariff rates now. It's even more fitting than it usually is. But a ship is not built out in the open ocean. A ship is built in the safety of a harbor in calm waters, and it is designed and engineered to withstand extreme seas and turbulence when it's crossing the Atlantic. When it finds itself in the middle of a storm out in the open ocean, that is not the time to renovate the ship. That is the time to be diligent in your course, the direction in which you are sailing. And similarly with your portfolio, we find ourselves right now at a point in time when we're kind of out in the middle of the ocean in the middle of a storm. Now is not the time to become more conservative in your portfolio. And I love referencing this. I'm going to share my screen really quick. I love referencing this illustration. I've had it for years. Deciding to create a more conservative allocation at a time when the market has just experienced a big decline, similar to deciding to learn how to use your parachute after jumping out of the plane. It's a little late. Now, of course, not to be flippant, I like this little humorous illustration there by Carl Richards, but many investors really are thinking and asking the question of, well, what do I do now? Obviously, rebalancing your portfolio back to your target allocation and making sure that target allocation is appropriate for you. That's something that you do before you're in the middle of the storm. But now that we find ourselves here, what can we do? So if you're an investor, you generally fall into one of two camps. One, you are taking distributions and living off of your portfolio. And then two, you are adding to your portfolio. You're not yet at the point where you have to take distributions. If you find yourself in the first category of clients and you're taking regular distributions from your portfolio, a couple of things to think of. So one, as I mentioned at the start of this video, not all asset classes are negative for the year. So that's the beauty of diversification. You don't have to sell from the S&P 500 index. You can be selling from bonds or from non-US stocks. And in fact, if you have a robust emergency fund on hand, and this becomes a more prolonged downturn, perhaps you give the portfolio a bit of a break, a bit of time to recoup, and you switch to using some of your cash on hand for those monthly distributions. Maybe you work through that emergency fund for a few months. Now, if you fall into the second category where you are adding to your portfolio, first off, if you don't already have an emergency fund that's at minimum 6 months up to a year's worth of cash on hand for expenses, this is a great example, a great reminder of how important that is. It's an incredibly important financial moat around yourself, if you will. You want to make sure that you have a robust financial plan. Cash on hand is definitely one tool in your arsenal. So if you don't already have a robust emergency fund, really double down and start building that up. If you already have an emergency fund and you have the ability to contribute more to your portfolio, this is a great opportunity. You're kind of in the ideal position where you can be buying at a pretty steep discount. 20% off, people flock to stores to buy something 20% off, and here you are, you're getting it in the market. So this is ideal timing for people who have additional funds to invest. And the last thing I'll leave you with today is a chart that crossed my desk this week that I thought was really interesting. And let me go ahead and share my screen here. It illustrates back during the global financial crisis of 2008, 2009, if you had just been an unlucky investor, invested in December 2007, and you held on all the way to the worst day of February 2009, what the outcomes would have been through 2024. Investor A, we can see, held on. So they made it all the way to February 2009. They decided, you know what, I'm just going to stick it out and I'm going to keep investing, or staying invested rather. And at the end of 2024, you can see that initial $10,000 investment grew to $56,000. Now, here's what's really fascinating to me. Investor B got to February 2009, the low point of the global financial crisis, and they decided, I can't take it anymore. I'm going to take my money and I'm going to just sit out for just 1 year. Just let the dust settle a little bit. And you can see when they got back in 1 year later, that amount grew to $36,000. So $20,000 less than investor A, just from sitting out of the market for 1 year. I thought that this chart did a particularly good job driving home the message that even taking a short break out of the market can be really devastating to your long-term results. And what we do know is that long-term, those who stay invested, who are disciplined with their rebalancing to their target asset allocations, continuing to buy into the market, kind of just these boring, predictable things time after time over long periods of time, those investors are rewarded with really stellar long-term growth and excellent returns, again, over the long term. And it's really hard to hang on during times like these, especially when you see the market drop 10% over 2 trading days. Get it. We're here as a resource. And if you or anyone in your life is finding that really challenging to do, please do lean on us. We're happy to have a conversation with you. That is literally why we are here, because our number one priority is getting you through the storm and to the sunshine on the other side. And we want you to be a successful long-term investor. So please don't hesitate to reach out and use us. All right, take care.